Hello and welcome to James Talks Finance, the show where we aim to simplify the world of personal finance and financial planning to enable you to get control and take action to a more successful financial future. In this episode, I'm going to discuss investing with you, keeping things at a high level rather than going deep into the weeds and using lots of complicated jargon and terminology. So first things first, why do people invest currently and why should you consider investing? Well look, as I see it, there are only really three reasons why people choose to invest. To obtain required returns to meet specific goals and objectives in the optimal way. For example, to accumulate sufficient assets to be able to no longer have to work. To provide greater financial options for the future. Or so that the value of their assets are not eroded by inflation. To me, everything else around investing is just noise. The argument that is often made against investing is that it is risky and that you could lose money. But once you factor in the risk of inflation, all types of assets can be considered to have some risk, even cash deposits. With that said, there is definitely a place for cash savings and deposits to be suitable, but typically for emergency funds and short-term holdings. So assuming that you think it's a good idea, how do you go about doing it? Number 1, select your tax wrapper. When it comes to investing, the tax treatment and rules that support the holdings are important. If not correct, it can lead to more tax being paid than is necessary, or an inability to access holdings before a certain age. In the UK, we would normally think about filling up ISA tax wrappers for holdings where we might need access in the medium term, or pensions if it's less of an issue, with other tax wrappers used when allowances have been used up. Number 2, select a product provider. We now live in a world with lots of choice and competition, which is great because it creates price competition, but it also creates a dilemma with knowing what to filter. With this, you're looking for a provider that's regulated, has the tax wrapper or wrappers required, competitive charges, a wide and reasonable range of investment options, and easy functionality to be able to use it. This may well be personal to you, your circumstances, and how much you have available to invest. Number 3, consider an overall investment approach. When it comes to investing, you broadly have two options of approaches. An active approach to try and outperform the overall market or benchmark by being more selective and concentrated, but believing in the ability to find price opportunities, or to take the collective wisdom of all investors with a less concentrated, more diverse approach without looking for those extra opportunities known as index investing, sometimes called passive investing because it typically involves less changes to holdings in the short term. This is a much discussed area and it's very divisive, so we won't go any further than that other than to say do your own research and make your own decision. Number 4, incorporating preferences or exclusions. There might be certain types of investment opportunities you want to lean into for a particular reason or exclude for a particular reason. This is personal preference based on your own moral feelings and thoughts, but it needs to be incorporated in what you decide to invest into. Number 5, growth defensive split. This is where you're thinking about how much risk or movement you're prepared to tolerate. Historically speaking, growth assets have delivered greater returns, but with greater risk of capital loss and short-term declines. When we're thinking about growth assets, we're typically talking about shares and property, with the opportunity for capital growth as well as an income stream. Some people might also include alternative assets within this, but it would take too long to explain each of those in detail. By contrast, when we think about defensive assets, they're incorporated to provide lower returns, but with greater certainty and lower risk of capital loss and short-term declines. Here we're thinking about cash and cash-like holdings such as money markets, or corporate bonds and government bonds, which are effectively loans to organisations in exchange for an interest rate known as a coupon. For most people, it's about finding a blend between the two that you're comfortable with, which is personal to you. Number 6, the actual underlying holding. This is where you decide upon something to meet all of the criteria of the decisions you've made in numbers 3, 4 and 5. People obsess about getting the correct choice here. There are lots of options, but using the framework first helps them narrow this down. People typically choose to invest into a fund or funds which have a range of underlying holdings to benefit from diversification, pooled costs and day-to-day professional oversight, as opposed to buying each holding directly. So there you have it, why people should consider investing and the framework of how to make decisions. The final thing to say is not to try and overcomplicate things. Simplicity is optimal for decision making, understanding, monitoring and maintenance. I look forward to catching you on the next one.
This show is intended to be for guidance and information purposes only and should not be considered personalised financial advice.